Welcome to the Fireside. Guys, we're all about business solutions here and supporting each other in business and life. So if you need anything, even if it's unobvious and you just hit a wall with some that you're facing, reach out to the team here. We've got a great team who they've specialised in their different areas. So make sure you reach out and get in touch with us if you need anything. Thanks so much to Jason for joining us tonight. He's helped out several of the lads in the group with really complex situations, and he's very innovative and works very hard to help every client, big or small. Just absolutely brilliant. So it's great to have Jason here tonight. Thanks, Bobby, for being MC again tonight.
Nice one. All right, I'll take it from here. So Jason, mate, tell us a bit about your business. How did you start it, and what is it that you do?
Yeah, good question, Bobby. What do I do? So I guess you could say I'm a mortgage broker if you just want to simplify it and dumb it right down. But basically, we work a little bit different than just say a mortgage broker. We work with mostly investor and self-employed clients who want to grow a property portfolio. So we do a little bit less just mum and dad, first home buyer, that sort of stuff, and more look at how we can structure finance, because that's the number one hurdle most of our clients face is they earn good money, they've got plenty of equity, but how can we structure it so the banks keep giving them more money? And that's the sort of client that we really work with.
Yeah, brilliant. Okay, so that's a great point to start off on. So what sort of problems do you find that they come to you with?
Yeah, good question. I mean, I guess there's different problems that we have, whether you're a PAYG or self-employed client. I guess I'll keep it self-employed focused, being most of everyone here is a business owner. I guess it comes down to the main hurdle that I'm sure most of us are in this group have ever had to borrow money once the business starts is what income are we using to show the bank that we're good for the loan, right? Most of the big four banks will generally want your tax returns. The downside of that for a lot of maybe small to medium businesses is their turnover might be large, but they've got a really good accountant like Tim and does a great job at minimizing their tax. And sometimes that can be a hurdle with their borrowing capacity. So we roadmap what does it cost to maybe go to a second tier lender, get a loan approved off your BAS statements alone versus paying that tax, paying a bit of extra tax and using a tax return. So, potentially for a 0.5% loading on your interest rate, which on $1 million loan might cost you $5,000 a year, you can avoid having to provide up-to-date tax returns to the bank and just use your BAS statements to get your loan approved.
Yeah, brilliant. Okay.
Now, for a lot of business owners,
this is a great point. And I think we've hit on something really big to start with. So can you just go into briefly the difference between the two and how they work?
Sure. So if you wanted to walk into CBA, Westpac, ANZ and get a home loan, generally they're going to want your last 2 years tax returns, and they're going to want to have a look at your taxable income. So your net profit after your taxable income, that's what the bank's going to use to work out what your borrowing capacity is. There are many lenders out there that understand that especially for business owners, sometimes that net profit has been really minimized by a really good accountant out there. The accountant's job is to get them paying as little tax as possible, which sometimes is counteractive to borrowing money from a bank. So we will sit down with clients and provide them the options that, okay, we can take your tax returns and, CBA or Westpac might allow you to borrow $1 million. But in order to get that $1 million, you're paying potentially, 150 grand in tax. Whereas if you want to potentially declare a little bit less income, work with your accountant, we can get the loan approved just off your BAS statements. And yeah, you might pay potentially $5,000 in interest extra on your loan interest rate, but you've saved yourself potentially 50 grand a year in tax. So for many business owners, that's a smarter way to work with your money.
Amazing. That's actually a really strong point. So as far as the business owner is concerned, is the process different or the same by going through each of those different channels?
Well, it's actually a lot easier with BAS statements, right? So a lot of lenders out there, the smaller lenders find BAS statements to be a better representation of how your business is turning over. So it's a matter of just providing 4 BAS statements, sometimes even a letter from your accountant, and you can be approved in 24 hours. It's actually a much faster process than providing 2 years tax returns and letting the bank go line item by line item on all your expenses.
Wow. Okay. So it's a significant difference. And is there risk on the second branch there of going with a slightly higher interest loan? Are there any sort of catches there that could potentially see someone come unstuck?
Not really any catches. I guess the risk is on the lender, right? The lender's the one lending the money out, and I guess when they're assessing your eligibility, it's not just numbers on a paper. They are looking at your holistic package. What's your equity behind you? How long you've been running the business for? How profitable is it? And the lender's making a call that they're happy based on the information provided to lend you that finance.
Yeah, wow. So in other words, the range that the Big Four are willing to engage in is like the middle of the market, the safe part of the market, whereas these other lenders are able to take on a bit more risk, or they've got a bit more of an appetite for risk, which means there's a lot more people that are eligible to borrow the money, right?
Spot on. So, the Big Four, I guess they can pick and choose what sort of client they want. The smaller lenders in the marketplace, they're hungrier for the business. They've got smaller market to work in. So they've got to take some risk on to try and, find an area, find a niche that they can lend in. But even sticking to the Big Four banks, the policies between the banks differ greatly. So NAB, for example, will allow, let's say the business made a net profit of $1 million, for example, right?
Yep.
NAB will only tax that on their calculations at 25%, so the business tax rate, whereas most of the other Big Four banks will tax that at 47%, assuming you drew it out as a personal expense. Now, that has a massive difference to someone's borrowing capacity. A 25% tax rate or a 47% tax rate on that money, the difference between going through NAB or CBA with exactly the same financials could be $1 million extra on your borrowing capacity.
Wow.
So the key part is about working with a broker who understands your situation, because finding the right bank at the right time for your situation, that's the key point.
That's it, man. This is actually really good stuff. It's interesting because, I think the average layman probably wouldn't know this stuff. And the reason why I say this is because the Big Four banks just, they've got all the marketing. That's where everybody goes. The first person you call, it's like, I'm going to go straight to CBA and see what they can do. And I'm sure what happens to people is that benchmarks where they think that they sit within the market. But unless they go out and speak to someone like you, Jason, then they're never going to know that these other options are out there.
Well, exactly right. And we happen so many times, clients really trust their bankers. They might really like them. Their banker might be genuinely trying to help them, but the banker is bound by whatever bank they work for, their policy. The banker's not going to turn around and say, hey, we can give you 1 million. They're not going to let you know that the bank down the road might give you 1.5 or $2 million. So unfortunately, people build up such a great relationship with their banker, because when you're a business owner, the bank's a pretty important part of your stakeholder in your business. So they build up that great relationship, but sometimes it's proof that you really need to deal with a mortgage broker who specializes in dealing with your type of client before you go to the bank. And that's one of the biggest mistakes people can make, is trusting what their banker has told them, because their bank is probably trying their hardest, giving them honest advice, but they're only giving them the policy of the bank that they work for.
Yeah, understood. Okay, so Jason, can you touch on some of the recent legislative changes and how that's affecting the market out there?
Absolutely. So we work with a lot of investor clients, and the market is a little bit spooked right now. I'm sure Tim and all the other guys can attest to that. People are a little bit worried. They're a little bit hesitant because of the negative gearing changes. I don't think, and I think probably for the next short term, maybe the next 6 to 12 months, especially in certain areas, the maybe $1.5 to $2.5 million price range, I think that's probably going to soften a little bit. There's going to be a complete lack of demand there. Investors are going to be out of that market, because to buy a property for $2 million as an investment, it's going to be very negatively geared. Now you can't claim those expenses. I think that area of the market will soften, but the market in the sub $1 million range, maybe 700,000 to 800,000 mark, I still think is super competitive. You're attracting first home buyers. You're attracting investors still at that point, because it's not very negatively geared. A lot of properties around that range are near enough to cash flow neutral. So the sub $1 million range will be competitive based on the changes. But I think that north of $1.5 million, if you're looking to buy a property around that point, it's probably a good time to buy in the next 6 to 12 months.
Yeah, absolutely great. And I'm seeing that in my area as well. Anything that's sub 1.1 is still absolutely leaving the market very quickly. Anything above that, it's softening up, and there's not a lot of demand.
Yeah.
So with that, what sort of trends are you seeing? With business owners at the moment, is there hesitation? To borrow? Is that all reflecting in the market? Is that what you're seeing?
No, I still think, I think the biggest driver we're seeing a lot at the moment is with clients with ATO debt. That's probably something that's being increasingly popular, which has never always been a lot of clients reaching out, because as business owners, we can all attest to the ATOs cracking down a little bit. You can no longer use them as a bank and rack up a massive debt to the ATO. They're charging quite substantial penalties. They're charging interest. And most importantly, you can't claim the ATO interest anymore as an expense. So that 10, 11% the ATO is charging you is no longer deductible. So a lot of businesses that owe money to the ATO are restructuring that, getting it as a debt that at least they can claim the interest on tax as well and get the ATO off their back.
Yeah, understood. So you essentially, instead of doing a repayment plan with the ATO and paying interest on that, you borrow at a lower interest rate without the penalties, and then you pay it off that way.
Yeah, exactly right. The interest rate isn't even that much lower, to be honest, depending on whether you're securing or unsecuring that ATO debt. But at least if it's a term loan, you can claim the interest as an expense, and the payment plans that the ATO are coming up with are extremely harsh. Whereas at
Hmm.
least if you borrow that money over a 3 to 5 year period, it's much more reasonable repayment terms. I had a client that he owed about 250,000 to the ATO, and their version of a payment plan was, I think, $80,000 a month for the next 4 months or something like that, right?
Yeah, yeah,
Which is unreasonable for almost any business would struggle to get that paid back. Whereas if you refinance that into a term loan over 3 years, all of a sudden the payment was only 15,000 a month, much more manageable.
wow, yeah, massive difference. So do you think with these recent changes that the banks are actually changing the way that they're dealing with risk?
Yeah, it's a good point. I think the banks, I think they'll have to soften up their touch their policy on risk a little bit moving forward, because the banks are behemoths at making money, right? These
Yeah,
changes are going to impact demand, and they're going to have to find a way to open the doors to a few more clients, I think. So I think, wait and see with the next 6 to 12 months. I think potentially there might be some changes coming from the banks as well. I don't think CBA with the organisation that they're going to allow their market share to start dropping by 10 or 20% on their loans. I think they're going to find a way to lend to more clients.
yeah, understood. And so I guess the term that gets thrown around a lot is borrowing capacity, right? And
Yeah.
I guess what's happening here with the rates going up and the legislative changes, and obviously the changes to the ATO as well. I guess what we're really saying is that's actually affecting people's borrowing capacity. Is that right?
Yeah, absolutely. So we're not being able to claim your negative gearing expense. That's automatically about a 20% reduction on what your borrowing capacity would have been. So before May 12th, your borrowing capacity might have been $1 million, which might have been enough to get you an investment property or something where you are looking to buy that investment. But now that's only $800,000. So that's a material difference. If you're looking at a particular suburb and the median price was around that $1 million mark, you're all of a sudden priced out of that suburb and you have to look at an inferior area. You're not going to be alone. Everyone's feeling the pinch on the same area. And I guess the key is to structure your finances appropriately, make the plans, because the negative gearing stuff, that's probably not going to go away in the short term. We're going to have to work around it and make your borrowing capacity better by tightening up other areas.
Yeah, yeah, yeah. Understood. So, what about like business debts and personal debts, and how they come into play in regard to banks trying to work out your borrowing capacity?
Perfect. That's one thing that we have a conversation with clients all the time, because again, looping back to our earlier point, that different banks have different policies. So we can't treat it with a one size fits all glove. Some banks will include those business debts into your borrowing capacity, whereas many other banks will exclude those debts from your borrowing capacity. So the key point here is choosing the right lender. You know, if One lender is going to exclude your business debts. Some will want verification, maybe from a letter from your accountant that business is profitable and can pay its own expenses. There's some banks that don't require even a letter at all. We don't even need to comment on it. As long as we're not using the income from that entity, they'll exclude it completely. So there's many different banks out there. We work with around 40 different lenders. And the key takeaway, hopefully, this is they've all got different policies. So don't walk into your local bank and the answer you're given is not the final answer. That answer might be their specific policy. The key is to reach out to a broker who deals with these banks every day, who knows what all of these 40 plus lenders we work with, their policy, how they treat things, because the changes are vast between one bank to another.
Wow. Yeah. And that's that benchmarking, isn't it? It's almost like the first quote you get dictates how you're going to approach the thing, you know?
But it's crazy. The numbers, can be eye-watering. The same income, the same equity position, the same employment terms, but one lender might give a 50 to 100% more borrowing capacity than the other. It's some of the differences we see are eye-watering.
Wow. Okay, so with that in mind, what can business owners do? Say they're not looking for a loan now, but they know that in the future they're going to need one if they want to scale. So what can business owners do to actually prepare when it comes to borrowing capacity? Is there something potentially I can do in my business now so that in 6 months' time I'm going to be ready to borrow?
Yes, spot on. To be honest, I think it's probably the most undervalued part is planning the property purchase. Most people know 6 to 12 months out that they might be looking to get an investment property or upgrade the family home in the near future. So the key part here is to reach out to the broker early on and work out a plan, because that plan might be, do we need to disclose more income for the company? Do we need to reduce some of the company expenses? Do we need to tidy up some of our accounts? If our account conduct, maybe we've missed a couple of payments, our credit scores dropped a little bit. So the actual key time is 6 to 12 months before you're looking to buy. Have a chat with a broker, get all your ducks lined up. So when you are ready, everything's already sorted. It's a matter of just going bang, pull the trigger, lodge the application.
Yeah, so when talk about those big four again. I understand that the idea is look outside the big four. What's the best way for people to do that? Obviously reach out to you, Jason. But in my mind, I can't really even think of how I would go beyond the big four. I think that's how much they've got the market sewn up.
Well, that's very true, right? And that's why I think for many, many years, the big four have had that sort of, control over the market. But that's changing, especially in residential space. In terms of a residential home loan, maybe less focused on business clients, but 81% of clients now go through a broker rather than dealing directly with their bank. So I think the market is wisening up that the right play, the smart play, is to go through a mortgage broker who can actually give you a review of all of the options, including options with banks you might not have even heard of or considered, but they might be a better fit for you. It's not all just about the cheapest rate. So some banks will be cheaper, but 99% of the conversations we have about which bank's policy fit your requirements the best.
Wow. So we got a question here from Sam, and he's asking about, he'd be interested to know in ballpark percentage increases versus standard employee loan. But I think what he's asking about is interest rates and the difference.
So it will be the same. So the banks don't charge, in the overwhelming majority of cases, in terms of residential finance, the banks won't charge a premium or a reduction, whether you're a self-employed business owner or a PAYG employee providing a pay slip. So in almost all cases, the rates would be the same. The only time that a self-employed person may have a premium is if they were using an alternate verification of their income. So if they were using a BAS statement, getting their accountant to write a letter to declare their income, in those cases, there might be maybe 0.5% loading potentially on the rate, just because it's risk. We've got to go to a second tier lender. And obviously the verification policy is a little bit lighter, so they might charge a little bit higher accordingly. But that's only in those instances. If you went to a big four bank, self-employed or PAYG would be exactly the same rates.
Understood. And say if you're a director in a company, so if the company's profitable, but you're drawing a wage from that company. How does that work in regard to the application for finance?
Yeah, so there's many lenders out there that will just take the wage that you are drawing from your company as your wage and treat you as a PAYG employee. So if you're drawing, let's say, $100,000 salary, and you've been drawing that for at least 6 months, there's many lenders out there that will just take your 100,000 salary on a payslip and verify that as your income. So there might be instances where you don't want to provide all your financials, because there might be times where maybe you're a partner in the business and the other partner doesn't want to disclose all of the income. Or I've had other instances where, due to privacy, because the business was looking to sell and they didn't want all their financial returns getting out there, they were about to be acquired by a pretty large company. So in that case, we used the director policy where we just took their pay slip as income verification. Quite often, that's a conservative way, because I think most of us as business owners would know, if you are drawing a salary, your company's probably making a lot of profit behind the scenes that you're not even declaring to the bank there.
Yeah, that's exactly right. Okay, so when it comes to making an application, what does a really good application look like versus maybe one that's potentially going to get rejected?
I think the importance of a credit score is important as well, having a good, tidy credit score. And that goes back to the preparation point 6 to 12 months earlier. When you sit down with a broker, if you're a little bit late here or there on a payment, the broker can sort of tell you what's affecting your credit score, tidy that up over the next few months. And then it really depends on which lender we're going through, but a good broker will let you know exactly what we need. They'll find the right bank and they'll make sure it's a one-touch approval. Using their experience, they'll know exactly what that bank wants to see and provide it accordingly.
Awesome. And so on the credit score, completely novice here. So if you're borrowing as a company or as an individual, does the credit score only apply to the individual or a company as well?
Good question. In the majority of the cases, when the company borrows, you as the director will provide a servicing guarantee for the company. So because you'll provide a director's guarantee, they will also check that director's credit score to check the director's credit worthiness. So it will still have an impact. Even if the company's borrowing, the director's credit worthiness will still have an impact on the application.
Wow. So even if the company's printing money, then they're still going to look at the director.
Well, exactly, because ultimately it's the director that pulls the strings, right? So if the company might be going tremendously well, but if that director has a history of missing payments, a history of defaults and arrears, at some point, I guess banks look at data, and at some point it's expected that that pattern will flow through to the business as well.
Wow. Okay. And so can you break down the credit score a little bit, just so we understand exactly what makes it up? What is a credit score and how does it function?
Sure. So a credit score is it really only affects only your personal liabilities will generally impact your credit score. So the company debts, the lenders might look at your personal credit score, but your personal credit score is really impacted only by debts that are in your personal name. So it just shows every time you make a payment on your home loan or a credit card, and conversely, every time you miss a payment on one of those facilities, it's impacting your score. So missed payments can have a material impact, and there's lenders out there that the really picky ones that, as little as 2 missed payments over a 2-year period would decline you for finance. So Macquarie Bank are notorious for this. They target only great borrowers. They offer low competitive rates, but there's a specific type of niche customer they want. And if you've missed, and when we say missed, I think it's 14 days late. If you've been 14 days late on 2 facilities over the last 2 years, they would instantly decline you for finance. So it can be quite ruthless with some of them.
That is ruthless. I'm just thinking back on my own history. I think I'm okay, but yeah. I don't know. So with that in mind, is there anything you can do to help
for free at any time? I encourage everyone to do it. It's good to know where you stand.
Oh, so you can just check out your credit score?
You can check your credit score for free at any time. There's companies out there, just Google it, check my credit score or something, and you can check your own credit score for free. And the score changes every month, right? And it's important. You might see something on there that, you might say, hey, well, hang on, that's not true. Well, that didn't happen. And sometimes banks put wrong information on your credit score. They say, there might be a default or they're chasing you for something that might not be the case. And you can get onto them and say, hey, fix this up. That's not true.
Wow. Okay, that's great. Hey, so tell me, when it comes to making applications, Does it matter what time of year you make an application? Like, is it better to do it around tax time or when things are required?
No, it doesn't make a difference when you do it. But I guess the last couple of weeks we've been super busy working with clients and their accountants about tax planning. So that goes back to our earlier point about the preparation. If you're preparing to provide tax returns and you want to lodge your application through the big four banks, we've done a lot of it over the last 2 weeks about tax planning with your accountant. So before your accountant finalizes the numbers in the next couple of days, we can actually work out what income do we need to qualify for that loan at ANZ? How much do we need as a net profit for CommBank to approve us that loan? So we can roadmap that out, forecast those numbers, let the accountant know. And then when he's finalising the tax planning for this year about the invoices you claim on the 30th of June versus the invoices you claim on the 1st of July to balance it all out for tax, he knows those numbers in advance.
Wow. Yeah, that's really smart. And so tell me about debt. So some people perceive debt as being a disadvantage. And other people see it as a golden pathway that's going to get them growth. So why is there a difference there in the way that people perceive debt, and how can it be a good debt?
Yeah, I'm definitely in the latter, the former there about the debt is the golden pathway for sure. But it's about how you structure your debt. It's not about having just debt and say eye-watering amounts of debt, right? We want to have debt on property and assets that are appreciating in value. We don't want to be taking out loans on facilities that are depreciating asset, right? I'm not advocating for car finance, credit cards, and all of that other personal debts. But debt to purchase a property, debt for cash flow for your business, debt to buy commercial property, all of those things, absolutely. If you can leverage yourself, if you think the market's going to grow 10% over the next few years, why not leverage yourself, borrow 80, 90, 100% of that value, use someone else's money to grow for you. And then all of a sudden, maybe you can buy 2 or 3 assets and put less of your own funds towards it.
Wow, that's brilliant.
I mean, not financial advice, of course. So please talk to your financial advice. Using someone else's money using other people's money is a great avenue to make wealth.
Yeah, okay, that's a good one. Okay, so let's take a scenario. Maybe a business owner who's been in business for a couple of years. They're doing pretty well. They've got maybe they're making 30 grand a month or something like that with relatively low expenses, which would constitute probably a large portion of the small businesses that are out there and starting out. What sort of scenarios have you seen play out for those types of businesses, perhaps when they're borrowing money to grow?
So you mean like in terms of cash flow lending and growing the business, or you mean property and stuff?
Yep.
So not really my wheelhouse too much. I must admit, I work on property-backed lending. So cash flow lending for businesses, not exactly my wheelhouse. And I generally refer those off to a few business bankers that I work with, because I stick to helping clients. My bread and butter is, I guess, helping clients, whether they be self-employed or PAYG, grow residential real estate property portfolios. That's, buy an investment property and then buy a second, use the equity, pull it out, buy a third. That's the sort of client that I work with that might turn their $50,000 deposit and $150,000 income, and 3 years later, you've got 3 investment properties from that. That's the sort of client that I work with.
So have you got like a real life sort of use case that you can tell us of a client that went from that pretty low base and was able to move quite quickly into a couple of properties, and how it worked?
Yeah, absolutely. And, even on the top end side of it, right? So, I mean, again, in terms of timing the market and market growth, there's been a number of pockets of Australia that have performed exceptional over the last few years. So the case studies that I'm going to potentially say are maybe not reflective over what we can expect in the next 5 years. Like properties in Brisbane and Perth and North Queensland, they've almost doubled since COVID times, right? That's unprecedented. They're on such a low base, and I think Tyson's on the group as a property investor buyer's agent. He's someone that can probably provide more feedback on which areas maybe you're going to grow over the next few years. But I've had many clients. I mean, I actually give the best one would probably be, and this is maybe not a client from a low base. It was actually an oncologist in Melbourne who came to me 3 years ago. actually before I started my business, I was working at CBA at the time, came to me and he wanted to buy an apartment or two in Carlton in Melbourne, right? And I had the conversation with him and said to him, you can buy this apartment in Melbourne that won't have much growth, pointed him towards a buyer's agent who ended up tipping him to a couple of properties in Perth that have tripled in value over the last, not tripled, it's probably doubled in value. He's added granny flats to them. He's made about 800,000 of equity in the last 3.5 years. Just by, it's a rinse and repeat method. We purchase the property, 3 or 4 months later, the market's growing, they've purchased under value, we refinance, they pull their deposit out and they go again. Wow. And you can just, if you structure your lending correctly, you can just rinse and repeat the strategy many times over.
That is fantastic. And I think that's probably a point that the guys would be interested in hearing about. So, sorry, how long did you say it was from when they purchased the property and then they're able to pull their deposit out again?
I've pulled the deposit out within 3 or 4 weeks, right? Because there's no minimum time frame. It's when the value is high enough. And a key point is if you're buying something that's undervalued, the value is already here. But if you've picked it up 50 to 100 grand below, you've already got equity sitting in that property. So you can ask the bank to value it. And the key here is all the banks use like what they call automated valuation. So it's just online data. So if you've picked something up lower, the bank might assign a value at still 50 to 100 grand higher than you've paid for it. So literally 2 or 3 weeks after settlement, we can refinance, pull your deposit out, put that back in your account, and then you're ready to reload and go again.
Wow.
It doesn't always work that way, of course. If you brought something at market value, it might take 6 to 12 months. 6 to 12 months for the market to grow, but that's the key about buying the right properties in the right area, undervalued, that you can pull that equity out almost instantly to rinse and repeat.
Yeah, that's great. And so I guess with the current market and the way things are, look, I'm sure that people are going to find opportunities. It's just the way it is. Is there any advice you can give to people out there, looking, at borrowing and getting to that sort of,
the key is research. There's still going to be many great buys out there, right? So do your research, find the areas that are growing. My probably pro tip that I always try and tell clients is, if you're buying growth areas that are growing, it's okay to overpay by $5,000 or $10,000 if the market's appreciating really rapidly. I think too many clients get focused on trying to put an under the table, a low ball offer in. If you're in a growing market, a market that's hot, it's attracting many, many buyers, sometimes you might have to feel you've overpaid by 5, 10, 15, 20,000 on that property. And you'll look back at a year's time when it's gone up by 50, 60, 100,000 and not be concerned about it. But I think that's one thing that holds a lot of clients back in booming markets is they feel like they're overpaying sometimes. Yeah. So the key is research your market and structure your finance correctly. That's probably the biggest one. If you don't structure your loans correctly, you'll get a roadblock at the banks very quickly. Property 2, property 3, and the banks will say you've hit your limit unless you structure your loans correctly.
So how should they structure? What part of the process is the structure, and what do you recommend there?
So my structure, and again, I'm not a tax accountant and everything, so this is not financial advice. And I definitely encourage looping in people like Tim, who's an expert. And I've referred a few clients to Tim who have been delighted with his service. But basically, if you're looking to buy properties in your individual name, no matter how much money you're earning, you're going to hit a roadblock at some point. If that's investment property number 2, number 3, or if you're really lucky, number 4, but we're all going to hit a roadblock with borrowing in your individual name. Instead, if you used trusts or companies to buy those properties instead, they can potentially be excluded from your borrowing capacity moving forward, so they don't hinder your ability to acquire the next property.
Are banks just as likely to lend to the trust as they are to you?
Well, trust lending's been a little bit in the spotlight over the last 6 to 12 months. Previously, it was a lot easier to get trust loans approved. The banks are a few more checks on it. So a few of the major banks have now pulled back. So CBA will only do trust loans for existing clients. ANZ will only do them for existing clients. NAB will do them for anyone, but a maximum 80% LVR. So it has tightened up. Where it comes to trust lending, we generally use the second tier lender space. There's many smaller lenders out there that are still very aggressive, still happy for your business. And that's the key of a good mortgage broker. It's about finding the right lender for your situation.
Wow. Yeah. Fantastic. Well, I might I'll just see if there's any questions out there from the guys. We've got one from Sam. Let's say average Aussie is paying 67% on a P&I for an investment property, ? I'm not an expert.
What was the question, sorry?
Let's say average Aussie is paying 67% on a P&I for an investment property. That's your question. Do with it as you will. I'm not sure.
I really don't know how I'm going to answer
it. Sam,
Yeah, I mean,
all good.
Okay. Hang on, sorry. I think it's from the previous question. Can Jason give us an indication of current interest rates? So, yeah, I mean, there's some lenders out there, if it's your home loan that you're looking at, so your principal and interest property, some of those start at around 5.9%. Again, interest rate is determined on a couple of factors. It's based on your loan to value ratio. So the lower your loan to value ratio, the safer it is for the bank. So they will give you bigger discounts. If you're wanting to borrow 80% versus someone borrowing 60%, naturally 60% is safer for the bank, less risky. So they'll give you the biggest possible discount that they can sort for you.
Understood. Yeah.
Someone borrowing 80% might be borrowing at 6.1%. As opposed to 5.9 at someone borrowing 60%. So that's where we're at for owner-occupied. Investment loan rates started around about 6.2 up to around about 6.6, depending on the lender and the terms and things like that.
Yeah. And do you have a crystal ball? And can you tell us what's going to happen with interest rates for the rest of the year?
Definitely not, to be honest. There, if you'd asked me 3 months ago, everyone was saying that the sky's falling out and rates are going to be out of control. Now, all of the big four economists, except Westpac, are all predicting at least 2 cuts over the next 12 months. So, I mean, 3 months ago, they were saying we're going to be in the 7% territory not too long. Now, it'll be low 5s by this time next year, according to most of the major banks.
Yeah.
They change their opinions every month. So, to be honest with you, I think it'll probably sit flat for the next considerable period.
Yeah, I would agree. Yeah. Okay, so a question here from Tyson. Do you recommend interest only whilst building portfolios or principal and interest?
It's a great point. So it comes down to serviceability, right? So very importantly, most investors, again, we don't provide recommendations, but we'll encourage them to talk to their accountants and have a look at interest-only facilities because importantly, interest only, it might be a slightly higher interest rate. There might be a loading of 0.2 or 0.3% additional interest rate. But it might drop your monthly repayment by $500 a month. If your payment's $500 a month less, that might enable you to potentially leverage and get a second property because you're paying less out of your pocket each month. So most investors we work with would all be on interest only.
Yeah, understood. We've got another one here from Sam. What's been the most difficult part of Jason's business growth? If you're happy to share.
Absolutely. Okay, good point. So a little bit about myself. I've got almost 20 years working in this space, but I've actually only been working for myself for just over 12 months. So prior to that, I spent 17 years directly at CBA as a banker, right? So the hardest part was, I guess the politics of leaving a big organization and the shit fight over who a client belongs to, clients reaching out to us. So the most difficult part there is just not trying to burn a bridge because CBA is obviously an important business partner still for me. I still obviously write a lot of loans through there for my clients. So you can't burn the bridge with a little bit of a shit fight on whose client it is, to be honest with you. That's been the most frustrating part of my journey so far.
Yeah. Okay, I can see that, how that'd be difficult. Yeah, and a year in, what does the next year look like for you?
I think the next year, like by looking at my numbers here and appointments in my calendar, I think the next year is going to be a substantial amount of growth. The first year, you're coming out, you're just sort of setting yourself up foundation-wise, understanding how all the different banks' policies work. I'm quite analytical. I like to really cross the T's and dot the I's on every bank's policy. So the first year is really understanding all of that. And we still had a pretty good year. Year 2 was about growth, and that might be bringing more people into the business to help, maybe another broker or 2 more support staff. So I think year one was about just foundations, and year 2 is about growth.
Fantastic. Glenn has just sent through a message. Are there any specific B2B introductions you would like? It's a great question.
Fantastic question. The number one referral partner that I like to work with is accountants. So, I mean, if you have a great accountant, I would love to have a chat with them because, there's a million brokers out there. I think, in fact, about 22,000 brokers are currently registered. To be honest with you, and hopefully this part's not recorded, Adam, most of them are shit house, right? Most of
it's
them
okay
are
to say that even
absolute
if it is recorded.
who don't understand the simple, the basic things, right? I mean, I'm not saying experience is everything, because you could be a 2-year broker and you're a superstar, but 20 years experience, knowing the bank's policies like the back of your hand. I've seen every scenario possibly imaginable. We find solutions for our clients, and we help them grow wealth. And when we talk to accountants, most of them quickly figure out that we're a step above the average broker. And if we can help their clients, and if their clients come to them in a need saying, I need this, I need that, most accountants we work with, they feel it's important to refer them to someone that's going to really look after their client. And hopefully most accountants have been happy with what we've done there. So accountant introductions are definitely the most important one for us.
That's great. That's a great question, Glenn. Okay, but we're probably coming to the end of it. Is there anything else you'd like to cover before we sum it up?
No. Hopefully, I probably waffled on a little bit too longer than I planned here. So
it's been fantastic. I mean, I personally learned a lot, which is great.
But one thing I would say is, reach out to me, right? Even if you've got a chat, if you've got a scenario, or even if it's your cousin or your mate or your niece is looking to do something, I don't think we can overstate the importance of a good broker. Like I said, there's 22,000 brokers in Australia, right? You want to be dealing with someone good, someone who's not just focused on a transaction. I think too many brokers are just worried about this transaction, trying to achieve your immediate goal. We like to think that we work, what's your goal now? Where do you want to be in 5 years? And how we can structure things to make sure there's no roadblocks along that way.
Yeah, fantastic, man. Look, on a personal note, I've learned a lot, and I can tell by your enthusiasm and how passionate you are about this, and your knowledge about it, that, mate, I think your business is great and it's going to fly. So, gents, to the guys out there, if you do know anybody to introduce Jason, we'd like to reach out yourself, please do.
Absolutely, and a shout out to Adam as well. He's referred me a number of guys from the overall network, the extended network, all been great fellas, and I think I've a couple of them. So Adam's referred another bloke, Adam, who I think has given me about a dozen blokes on the Gold Coast to do loans for, right? So it's been a great opportunity for someone who's starting a new business. That's a great networking opportunity. So shout out to Adam for that.
Yeah. Terrible at getting us on here on the platform, but great at everything else.
He's great at connecting everyone. He's a people person.
Yeah. All right, Adam, you want to take it away?
Thanks, guys. That was just brilliant, Jason. A lot of valuable information there. But
really good.
This is something that affects everyone, even if you're not currently investing. What the changes over the next year, it's going to impact everyone. So, and I know everyone in the group, if they're not currently in the property market, they're looking to get into it. So, very valuable information and very insightful, Jason. So really appreciate the wealth of information that you've shared tonight. Also, thanks to Bobby for interviewing Jason and answering the questions, and that just brilliant work. Thanks, guys. If you need anything, reach out. You can message me, Jason, or anyone on the panel, or reach out through the website and get in touch if you have any questions on any of this. Thanks, everyone.
Wonderful. Thank you, Adam. Appreciate it, mate. See you, Jason. Great to chat.